Good afternoon, and thanks for joining us today for our live teaching event on listed hedge funds. My name is Jo Groves, and I'm joined today by my colleague, William Heathcoat Amory from our analyst team at Kepler. William's going to start proceedings with a 25-minute presentation covering the role of hedge funds in retail portfolios, together with an overview of BH Macro, which provides a liquid access point to a top-tier global macro hedge fund strategy managed by Brevin Howard. We'll then have around 15 to 20 minutes for Q&As. So if you have any questions you'd like me to put to William, please do put them in the Q&A box at the bottom right of your screen, and we'll try to get through as many as we can in the time. So without further ado, over to you, William.
Thanks, Joe. And I'd like to emphasize that actually, there is no such thing as a silly question in this session. This is supposed to be a teach-in on, what in some cases is a sort of slightly mysterious area of the investment world. Hedge funds, there's a lot of mysticism in them. So please do, ask any questions. We'll try and get around to them. So let's just make a start. Starting at the very beginning. We think there are really three reasons why you might want to invest into a hedge fund, and really we'll be drilling into each of these in turn. But generally, hedge funds can provide investors, as it says here, with alternative sources of return and most importantly, targeted risk exposures. Now, the hedge fund investor base has evolved over time, and I think through time, obviously, different parts of or different these three categories have come to the fore at different times. But generally, I think one can assume that these three have been fairly constant over the history of hedge funds. So turning first to the first one, which is alternative return sources. These fundamentally, hedge funds give an exposure to very, very different strategies to your classic equity or bond fund, which typically have a sort of beta to their benchmarks of around 1. Hedge funds give exposure to, as I said, different asset classes, but also different strategies within them. And in sort of modern parlance, they give you exposure to alternative risk premia. So what are those? We categorize, you could categorize hedge funds into broadly 6 different categories. They'll all have very, very different strategies or risk and return scenarios even within these strategies. So it's very hard to define exactly what a hedge fund is, and it's more, I think, more what it's not, which is a directional beta 1 benchmark plus or minus exposure. Now, just quickly diving into these 6 categories. Equity long short. This is effectively where a manager might be buying companies he thinks are undervalued or going to appreciate in value, and shorting or selling companies he doesn't own that are overvalued or he thinks the value is going to go down. Now, this actually, aside from the fact that it potentially adds, doubles the amount of alpha or value add that the manager can deliver to investors through his own thoughts about which companies he's buying or selling. It also can, depending on what proportions between the long and the short book, it can mean you get a market exposure that's considerably less than a beta 1 exposure. So at its most extreme, you have a long book of 100 and a short book of 100%, let's say, which means the net exposure to the market, or if the market was moving around, you'd have almost no market exposure, which means there's a big equity market shock. Theoretically, anyway, you'd hopefully not have anything like that risk in your long-short portfolio. So then turning to global macro, these are effectively funds that take long or short positions in a wide variety of asset classes, including equities, bonds, currencies, and commodities. And generally, these managers are looking at sort of macroeconomic factors to inform what they're doing and what they're positioning the fund. Relative value, these are looking to exploit price anomalies between different asset classes or within asset classes, so equities, bonds, commodities, currencies, and they're pretty all-encompassing, or can be very all-encompassing in terms of the asset classes they look at. They're not restricted to equities or bonds typically. activist funds and event-driven. Event-driven we see as a sort of subset of activists, but activists are effectively investors who take significant positions or stakes in companies in an attempt to instigate operational financial changes to improve shareholder returns, such as a restructuring or a sale of assets. And event-driven is sort of the other side of that, in that they are trying to take advantage of pricing opportunities that arise from corporate events such as restructurings or mergers and acquisitions, and they can often buy distressed debt or short companies if they expect them to go bankrupt. So but they tend to be pretty concentrated and in themselves. Fixed income arbitrage, they're effectively sort of a long short equity fund, but in bond markets. And obviously there's all sorts of different types of bonds that you can invest in or go short in. And then quantitative, these are the mathematical models and algorithms that make decisions on trading, and they're often very high frequency and can be very idiosyncratic or not related to what equity markets do. But what's clear from all of these things is that they're very different in character from your standard equity or bond fund, and usually much less directional than equity or bond funds typically are. So risk mitigation is another reason why you might want to invest in a hedge fund. Effectively, what hedge funds typically aim to do is to, whatever their strategy is to invest in and generate good long-term returns, but with a real awareness of risk, and in some cases trying to minimize risks entirely. And the measure that a lot of people use to measure risk is volatility. And this graph here just shows the volatility ranges for many different traditional asset classes and hedge funds over time. What you can see on the left-hand side is that equities have obviously the highest returns over time, but they have significantly higher volatility than most asset classes. And that's absolutely fine. But obviously, when you're trying to compound returns, volatility is a big drag on compounding. For instance, it's a mathematical fact that if you're up 30% and then you go down 30%, you're actually down 9% overall. And that's the sort of thing that hedge funds are trying to do. They're trying to generate compounding returns over time by minimizing the risks that they take, or the volatility. And it's a classic tortoise and the hare scenario. The hare would be equity markets, and the tortoise is hedge funds. They're not trying to beat the lights out every year, but what they're trying to do is compound returns over time. And that can actually help. It reduces the volatility overall in a portfolio, but also if the portfolio is being rebalanced regularly, it can really help counter the effects of volatility in equity markets. Because if equity markets are having a very poor time, and your hedge fund allocation has not gone down by anything like as much, if you're rebalancing regularly, it may help you to sell your hedge fund or a portion of your hedge fund portfolio and reinvest into equities at arguably lower valuations. So that's another part of why people might have a hedge fund allocation in their portfolio. So turning to the last and probably most important reason to invest in a hedge fund is really portfolio diversification. I think hedge funds are one of the very few diversifying assets over time. They have obviously generally highly paid managers looking at markets, applying the strategy, but they're very dynamic in the way that they react to market conditions or change the portfolio, and that's a critical part of what they bring to a portfolio. So Harry Markowitz, who died last year, he was famously quoted as saying, "Diversification is the only free lunch in investing." And I think that's critical. What we're not talking about is that these assets or these hedge fund investments are risk-free. They're more that they are a good way. They're not related too much to equity markets, hopefully, or bond markets. And the real point, if they are uncorrelated to equity or bond markets. It means that your risk-adjusted returns are improved, and your risks are truly spread rather than not. So again, diversification is all about not having all your eggs in one basket, and hedge funds help that. And Harry Markowitz actually came up with a concept in the 50s called the 60-40 portfolio, which he saw as a sort of easy benchmark or easy way of constructing a portfolio that was much more stable than one exposed 100% to equities. And the reason for that was, it will be apparent in the next graph, is that the correlation between equities and bonds, certainly in, when he was initially came up with his theory, but for several more decades after that, bonds were inversely correlated to equity markets. So what that means is that equity markets might go up, bonds might go, the value of their portfolio of bonds might go down. But if equities sold off, typically the value of bonds would rise. And that was a pattern that sort of held broadly true for many decades. Now, one of the reasons that I think hedge funds are really useful now is that for the last 20 odd years, that the era of the inversely correlated equity and bond, or the correlation between equity and bonds, which was previously inversely correlated, they actually become more correlated. And this graph, which we got from Amundi, illustrates that. And who knows why? It could be different types of eras. It could be types of equity investment. The background to equity investing, but what's clear is that relationship broke down, and has broken down. I mean, who knows where we are now? The most illustrative example, notwithstanding the most recent election we've had, but when the reaction to the recent Labour government, bond and equity prices sold off, which might suggest that equities and bonds are not uncorrelated with each other still, and really that's the critical part. So the point about hedge funds is that they do they can be lowly or uncorrelated with equities and bonds. And this slide shows a classic, on the right hand side, a classic sort of efficiency frontier of returns, and on the left, on the vertical axis, on the horizontal axis, volatility. So what you can see is at the top right hand side, you've got your 60-40 stocks and bonds portfolio, which Harry Markowitz pioneered. And what you can see is that adding actually quite a significant amount of managed futures, which is a type of a trend following hedge fund strategy, in theory anyway, it really increases, it doesn't affect your total return. So you only go from 6.7%, 6.75% returns to 6.5%, let's say, but you really materially reduce the risks or the volatility from about 10 down to 7.5. And that's really sort of illustrative of the fact, the effect, or the diversifying effect of having an uncorrelated asset in a portfolio. So on the left hand side, the Sharpe ratio is basically a measure of risk-adjusted returns, and what it shows is that adding a strategy or a fund that's uncorrelated to your existing portfolio will really quickly increase your risk-adjusted returns. And so the orange line, which shows adding 100 correlated funds to your portfolio, if they're all correlated, unsurprisingly, your risk-adjusted returns don't change. But on the other side, if you take the purple line, if you add perfectly uncorrelated strategies or funds, then your risk-adjusted returns, rises quite dramatically, and actually it keeps going. The problem being is that as you increase the number of funds or strategies, it's harder and harder to get yet more uncorrelated strategies in the portfolio, and that's the holy grail, is really trying to find uncorrelated strategies that deliver decent absolute returns, and then adding them to your portfolio, and you'll end up with a very high risk-adjusted return. So moving to the real world, which is illustrated here, in the last 10 years, this shows the returns of bonds and equities, which is the green and the light blue line, their returns over time, and really the impact of having a hedge fund in the portfolio can be illustrated, best in 2022, where both equities and bonds had very poor years, down high teen percentages, whereas hedge funds were actually up 10%. So or nearly 10%. So that's really a very positive contribution to a portfolio. Now, the only problem is it doesn't always happen, and past performance is not a reliable indicator of future results, as we're all told again and again, and it's absolutely true. However, so 2018 and I think 2015 were very poor years for equities and bonds as well, and in those years, actually, the macro index also was negative. One might say, well, at least it wasn't down as much as equities, but obviously it's not doing a great. It's not uncorrelated, and so that's the key, is that you can't rely on hedge funds to always be uncorrelated or always correlated with equity markets or bond markets, but they do add to a portfolio. So turning from macro funds are one subset of the hedge fund universe, but in this graph, which looks very, very confusing, but it isn't meant to be, shows a whole load of different hedge fund strategies, and their correlation over time to equities and bonds. And I think, apart from the fact that the squiggles everywhere, you can see that what we're trying to show is that actually there's no pattern that a particular strategy is constantly the same, structurally correlated or uncorrelated to equities on the left or bonds on the right. And the idea being is that that's the key to hedge fund as a diversifier, is that they are dynamically correlated with these markets. Sometimes they're positive, hopefully when you want them to be positively correlated with equity markets, and they're sometimes negatively correlated, hopefully when you want them to be negatively correlated. But I think the point is that they're, if you look at if you had a line there for equity funds, there would be, the equity correlation would be, a straight line at the top on 1, and against bonds it would be, as we saw in the previous, a few graphs ago, they tend to be correlated for long periods or non-correlated for long periods, but it's very the relationship is not very dynamic, and I think that's the key, is that hedge funds give you a dynamic correlation. So moving to the next slide, this is where we sort of start to look at BH Macro as a sort of example of a hedge fund. So all the previous graphs have shown sort of indices, and obviously you may have questions about which hedge funds fit within the index, or whether the index is representative of hedge funds. The great thing is that BH Macro is a listed feeder fund into Brevin Howard's master fund, and so anyone pretty much who's got access to the internet can follow their progress over time. It's very it's the opposite of opaque, put it that way. So what we've got here is, in the same way we had a graph that showed the rolling correlation to equities and bonds, we've got a graph here that also shows BH Macro's NAV correlation to equities and bonds. And I guess, without going into too much detail, what's clear is it moves around an awful lot over a relatively short period of time, and at times the NAV is correlated to equities and at times correlated to bonds, but that pattern doesn't hold very long, and that in itself tells me that the underlying portfolio is offering the prospect of diversification. Again, looking at the real world, the credentials of BH Macro as a diversifier, are really well encapsulated here. The orange bars, I appreciate the writing is quite small. The orange bars are BH Macro's NAV in any 1 month, and share price in the dark blue in that month. And what we can see is that the dark grey lines, which represent the 20 worst months for the S&P 500, BH Macro's NAV returns were positive in 18 of those 20 months, which shows that when you really need it, BH Macro and equities are selling off. BH Macro on the NAV basis has delivered positive returns, which means it's a really good counterweight to equities, or has been to equities in stress scenarios. Now the share prices we'll come to in a minute. The share price with any investment trust doesn't necessarily follow the NAV, and the share price has been positive in 16 out of those 20 months. So that in itself, shows that The share price is a good proxy for the NAV, but it's not perfect. We'll come to that later. So moving on, more about Brevan Howard. For anyone who doesn't know who Brevan Howard are, I mean, obviously they're a big name in hedge fund world, but not necessarily in the equity world or fund world. They've been going for over 20 years, have good amounts of assets under management, 34 billion. They have been through the ups and downs that any firm has. They're now truly global with 8 global locations, but they had a very good global financial crisis where they delivered strong returns when equities were really having a very tough time. But the period of the decade of sort of zero interest rates was very, very tough for them, and we'll come to that in a minute. But they saw assets under management fall, but they've basically through this period they've held true to the way they run money, how they think about things, and these 3 pillars of expertise have sort of basically stayed with them true all the way through. They haven't tried to reinvent themselves, but this is, which I think is a reassuring point. But we'll run through these in a minute. The performance and the AUM has really sort of seen a big rebound since, well, on the back of this very strong performance during 2020, during COVID, which we'll come to later, and in 2022 when interest rates were rising and caused a lot of stress in markets, especially in bonds. So Brevan Howard see their 3 pillars as macro thinking, trade structuring, and risk management. Macro thinking, as you can see, they have a large team, 155 traders. They've got 30 risk officers. They've got a big team of macro economists. All these guys share and girls share ideas across the firm, and it's but the key is that they're not necessarily trying to come up with what they think is the exact future path of the macroeconomic picture in the main economies. What they're trying to do is to actually work out what the market is pricing is going to happen, and then try and work out what non-consensus ideas would be from that sort of picture. And what the idea is that they then work out whether these the non-consensus ideas are a remote possibility, and if they are a possibility, then what is the market pricing in? And so really what I'm trying to say is that it doesn't really, the macro thinking is not necessarily that they have the perfect foresight or a crystal ball that predicts exactly what's going to happen in the future. It's more their ability to analyze what the market is pricing in, what is potentially possible if the consensus doesn't happen. Because that's when the trade structuring comes in, and what they're trying to do is they're trying to structure trades or investments that have asymmetrical or convex outcomes, by which I mean that they have minimize the downside but maximize the upside for every given unit of risk. And what a parallel the way that the trade structuring works. These guys are not bookmakers, but it could be looking at the way that bookmakers make money. So a bookmaker's job is not to pick winners in any race, but really to ensure that in any race they don't lose money, and ideally make money whatever happens in the race. But the way they do that, they ensure that there are lots of correctly calculated odds offered across the whole field, so that even if the favorite wins, the math should add up that they make a small amount of money come what may. But if a rank outsider wins, they keep all of the cash that the punters have been betting on the favorite, and pay out on comparatively few punters who back the outsider. But they make the least money when the favorite romps home and effectively the market was right. But the idea is that they've lured enough people in to make bets in that scenario on the outsiders, so that they can at least cover their losses. And in this way, sort of at Brevan Howard, losses are minimized if the market is right. But if the market is pricing the future incorrectly, then traders can make very significant profits. And this is what I take as trade structuring. The key is that Brevan Howard, in order for Brevan Howard to make money on their investments, it doesn't necessarily rely on their traders or economists' views of the future being correct all of the time. And a final part is risk management, which clearly permeates the whole business. For instance, the old head of risk was actually promoted to CEO a while ago, which really sort of illustrates how important risk is to the whole business. And each trader has stop losses, which they have to enforce, and the risk management team police each trader's books. And Brevin Howard described it as a sort of art and a science. Over time they've demonstrated that they have protected capital when things have not gone their way, which obviously inevitably it's never going to go their way the whole time. So this slide just shows really that long term they've generated attractive compounded returns. So 8.34% to the end of I think that's August, with volatility of 7.93, which is considerably below that of equity. So an equity-like return with around half that of the volatility of equity markets. It also illustrates that BH Macro is a feeder fund. It's £1.5 billion as an investment trust, but it feeds into a much bigger fund of $12 billion, which has been running since 2002, and that's the reason why the since inception total returns are slightly different, but not far from it. So the annualized return for the master fund is 8.43%, which is obviously very similar, and the volatility is very similar to that of the master fund because it feeds into it. Moving on, so this slide shows really, I guess some of the credentials of the diversification that BH Macro offers, and from the website there's a statement which I think captures it all quite well. It says the investment approach combines directional, relative value, and derivative trading strategies within this master fund, designed to deliver orthogonal but complementary returns. I had to look up what orthogonal means, and I've put the definition there. Effectively, it means that events that are statistically independent or don't affect one another in terms of outcome. And the point being is that by having a load of traders, having a load of stop losses, having risk managers, they all have, hopefully, all of the traders are their returns are statistically independent, and that means that there's a huge amount of diversification inbuilt within the fund. That said, overall, BH Macro has historically, anyway, delivered good returns when markets have been stressed. And this list here gives an example of how the current portfolio, or the portfolio at the end of August, would react if the same scenario were to happen again. And this is not Brevin Howard saying that they expect Lehman Brothers to happen. It's just if you were to apply Lehman Brothers to the current portfolio, what the NAV impact would be. They're not structuring the portfolio to have a Lehman Brothers or anticipating a Lehman Brothers scenario, but it's just if that were to happen, this is the returns that you might generate. So what I think is interesting is not the specifics, but more the general, that in all of these scenarios, the rogues gallery of stress scenarios, the NAV is up in all of those. And obviously equity markets almost certainly, or equity funds would almost certainly not be. So what that shows me is that as a tool in a portfolio, BH Macro may act as a sort of counterbalance to equity market falls. So moving on, this is just a picture of the last 5 years. We've got the NAV there against equity markets, bond markets, or UK bond markets, and against two of what we see the capital preservation trusts, Ruffer Investment Company and Capital Gearing Trust, and BH Macro have done well relative to them over this period. So quickly drilling into the sort of the good and the bad over the last 5 years, really, I guess, characterized by some periods which could be COVID. In that moment, a lot of central banks pressed the emergency button. They took emergency action, cutting rates, and in that scenario, Brevin were very big beneficiaries in terms of NAV returns. So one of the biggest monthly returns that they've ever had in March 2020, the NAV return was 18.3. Again, the share price didn't follow that perfectly, which is one of the drawbacks of investment trusts, or one of the opportunities, depending on what you see it. And at the same time, the S&P down 12.5. Now, obviously, that's a great time for Brevan Howard, terrible time for equity markets. The same happened. Well, the same actually happened in the global financial crisis. That was a long time ago. But in 2022, when Ukraine was invaded, energy prices spiked. There was volatility across markets. Again, Brevan Howard made very good money over the year. 21.2% NAV total return. The share price very closely tracked that. I think at that point the market had remembered that Brevan Howard was a good risk-off or diversifying tool, and so there were more people following it. The discount was narrow, or indeed there was even a premium. And at the same time, equity markets fell precipitously. So that was a good time for Brevan Howard or BH Macro. SVB, so that was a bad time for Brevan Howard at the time, on the back of there was a very, very big reversal in US interest rate expectations following the SVB bankruptcy. So the Fed had been sort of signaling that rates were rising and they were going to be to counter this inflationary spike. But with SVB going bankrupt, suddenly the expectation in the market was that they were going to have to cut rates to stop a sort of systemic bankruptcy issue in smaller US banks, and that saw a huge swing in a lot of the instruments that BH Macro owned, and that meant that the NAV was down 6. At the time, the premium to NAV was something like 10, or it was pretty high, and that meant that a sudden swing in expectations meant that the share price return was actually very poor, and at the same time equities rallied because the Fed were very supportive of the economy. So that was a very bad 6 months for BH Macro. A more recent example, just illustrating where BH make money, September 24, obviously very recent, so we can all remember it. The Fed cut rates by 50 basis points, much more than markets expected, and that meant that Brevan Howard happened to make nearly 5% in the month, and again the share price was up 2.5%. So that's the sort of good and the bad of the last 5 years. A key part of the last 5 years has been the significant shift in the share price rating. As you can see in this graph, back in mid 2022, whilst equity markets were falling off a cliff and everyone was very worried, BH Macro were doing what they do or have done historically and deliver good returns, and everyone was interested in buying them. There were capacity constraints in the fund, so the board couldn't issue shares fast enough, and the premium got to quite unsustainable levels of sort of 10-20%. And that obviously is very dangerous, as anyone who reads our website or the content on our website, that's usually cooking up trouble for the future, which is why boards always look to issue shares to stop these sort of sudden swings happen. Because what happened is that when a bit of confidence or where the performance didn't measure up to what investors were hoping for, suddenly there's a sort of big swing in demand, and there's more supply than demand, and the premium disappears and a discount turns up. Now the board have been buying shares back since then to try and counter that, but the discount, in common with a lot of investment trusts, is now still around 9%, which is quite wide. Particularly painful for anyone who bought the shares on a 10 premium, because notwithstanding the NAV not having done particularly well or done particularly badly, the share price reversal has been significant. I'm aware that I'm slightly running out of time. One of the reasons for the discount remaining wide potentially could be the fact that BH Macro has got, by comparison to equity funds, quite high fees. Typically hedge funds have a 2 and 20 model. Brevan Howard BH Macro is no different, but the impact of performance fees can mean on the OCF or the KID cost can get quite high. So an illustration being in 2022, it was a 6% OCF, which is quite high. No performance fees paid in 2023, so that was why the thing fell to 2.16. So still high, but fully in line with what hedge funds typically charge. So getting back to the beginning again, we think we looked at the 3 reasons why you might buy a hedge fund or where it fits in a portfolio, and I think looking at all of these 3, Brevan Howard's trader platform and the way they invest is very unique in investment trusts, but also is very different to your usual equity funds, and therefore is a true alternative return source. Over long term, they've delivered pretty good compound returns with low volatility, and then in diversification terms, they really have sort of come to the equity market, or come to your portfolio's help as a shock absorber when equity markets have really had a difficult time. All in all, we think Brevan Howard is the real deal. This is a disclaimer that says, you might say that because Brevan Howard are clients of ours, but we think they suit a really good as a worked example of a real live hedge fund that is available for investors to buy in pretty low numbers of AUM. Given you can buy a share on the London Stock Exchange, and this also, there's a lot of jargon here, but it is really to illustrate this isn't a recommendation to buy Brevan Howard macro shares, but you should get financial advice if you're considering any investment. So, Joe, I think hopefully there's some Q&A, but I'm happy to answer any.
Thank you very much for the presentation. We've had a number of questions, but do please keep them coming, and we will try to get through as many as we can. I'm going to amalgamate a few together. We've had a few about the discount. So one question around, we've seen the discount move significantly over the last 3 years from a premium to a discount, and it's currently around 9%, as you mentioned. So the first part of that is, do you see the discount narrowing as rates fall? And the following question is, how is BH Macro addressing this discount, and does it have a discount control mechanism?
So will the discount narrow if rates fall? Well, the answer is I think this is a bit different to, let's say, a high income investment trust that, one might argue that the discounts are because people are buying government bonds, which offer obviously a decent risk-adjusted return and a good income, and the extra risks that you're taking to invest in a high-income investment trust are there, and obviously on a relative basis, it's looking less attractive. So it's not an income basis, but it could be that people are investing in government bonds because of their risk-adjusted, or low risk and sort of semi-guaranteed capital returns or total returns, and obviously BH Macro was an alternative to that when bonds were yielding nothing. So I think it's hard to tell. I think in my view, the catalyst for BH Macro discount to narrow is really performance to improve, and for everyone to realize, as they did in 2020 and 2022, or remind themselves that the best time to own BH Macro is when equity markets are having a terrible time, historically anyway. So if they were to if the equity markets to sell off and BH Macro did a good job again, then I think the discount would narrow, as everyone suddenly was reminded that that the same characteristics that they've demonstrated so far still apply. And then the second question was, what are the board doing to address the discount? Well, the board are buying shares back, and that's a good thing. There is a continuation vote that's formulaically triggered when the exact terms are that the month-end discount on average over a calendar year, if it's wider than 8%, then that triggers a continuation vote. And I think I don't know exactly what the average so far is over the year, but obviously that's another protection, because obviously if investors are frustrated and they want to discontinue the trust, then they can, and they have a way of doing that. So those are the main discount control features, I suppose, of BH Macro.
Thank you. Another question is, can you break out the performance from October 2022 to July 23 in terms of how much was due to actual performance and how much was due to the change from a premium to a discount?
Okay, so what were those two dates?
October 2022 to July 2023.
Okay, October 2020. Well, I would have to. So BH Macro has got a really good website, which is a way of me saying that in order to answer that question, I would basically go to their website, have a look at their fact sheet, which has a full breakdown of all the monthly numbers, and then the commentary that comes in the interim and the final results is usually a very good way of tracking over and seeing where the contribution from returns has come from. But by and large, the NAV of BH Macro has not been that volatile, as it hasn't been as fitting with the picture of the previous since 2007 or 2002 when the master fund first started. And actually, I would say that in terms of shareholder returns, the majority of that negative return, if you're seeing that in your portfolios, is down to the premium eroding and the discount widening. And this is really illustrative here. So I can't even see if my cursor, but you can see, July, August 2022. That's really when fever pitch was reached, and the premium was routinely in sort of high teens, and that was I guess rather worrying probably for the board, given they couldn't issue shares to sort of satiate demand. And then nothing lasts forever. And when SVB crisis happened, that happened at the same time as or just after the board had issued a whole load of shares to satisfy that demand. And there was also at the same time worries about two of the biggest wealth manager shareholders in BH Macro, which were the merger between Investec and Rathbones, who still remain, very big investors, but there was a lot of market commentary that they, I think, unfounded probably, that they had a very large combined stake and they'd be forced sellers in the event of the merger. So there was sort of structural supply of shares, and that caused the discount to widen quite dramatically. So all of these things happened. It's obviously regrettable, particularly for investors who bought on a high teen premium. But as we say, that's obviously it's quite a unsustained. There are very, very few investment trusts have sustained a premium of more than 5% consistently, and so we're always a bit cautious about buying any investment trust on a premium of anything more than 3, 4, 5. Purely because of the risk that's illustrated here, that the sentiment changes and the discount will widen. And so, irrespective of what the NAV's done, you'll see from price terms not great returns.
Thank you. We've had a couple of questions around annual returns. So one being, is the stated average return of 8% before or after annual fees? And the second one being, are you able to provide any insight into the annualized return and volatility targets for the fund and any leverage targets or limits?
So yeah, all of these numbers are a net of fees. So that is obviously a critical part of the stat. So these are all after fees, and obviously Brevin Howard would argue that the reason they can attract all these impressive traders and get the best minds on the street is that they are able to offer very attractive remuneration if they're right, and that is critical. Brevin Howard unequivocally make good money if they make money for their clients, but they also don't necessarily make very much money if they don't. And so it's contingent on performance, and I think that's absolutely critical. There's that's critical. And then the second question was something to do with the Joe. What was
annualized return and volatility targets.
Oh, so Brevin Howard don't have return or volatility targets. I think what they undertake to do is to generate the best returns they can, given in the environment, but to minimize risk. So, all the way through, what I do anyway, as a observer of BH Macro, is to keep an eye on the drawdown, maximum drawdown, so the maximum loss they make in a sort of straight line, but also the volatility. And I think as long as those stay in historic patterns of returns, you know that nothing's changed in the way that they manage risks at Brevin. And what I am hopefully confident about is that time and time again, when equity markets have a tough time, BH Macro contributes positively and does a good job in offsetting some of that as a shock absorber, I suppose. And that's really, what I see their role in the portfolio as is not moving around too much in terms of volatility and managing those risks on the downside, because no one's right all the time. But when the proverbial hits the fan, then they ride to the rescue, hopefully. Although that's not guaranteed, obviously, in any scenario.
Thank you. Just to say, do please keep submitting your questions and we'll try and get through as many as we can. We've had a couple of questions around correlation. The first one being, do you know how the fund has performed and is correlated to volatility?
Oh, that's a good question. I wish I knew how to work Bloomberg, because then I could probably come up with a graph that showed that the correlation relative to volatility, or VIX. But I think anecdotally, what you can see is that, and I know, I've heard some people say this, that macro funds typically, and BH Macro as well, they are typically structurally correlated to volatility. So when volatility spikes, they tend to make money, and that's really two ways. First of all, the volatility is happening, and usually central banks or expectations of rates, FX, and bonds move around when there's volatility, and that means that they're hopefully, if they've got some bets on, as it were, in the bookmaking parallel, then that means that the outsider has sort of romped home, let's say, and they've hopefully collected some winnings. But also, the underlying portfolio is constructed using options and option-like sort of trades that are structured, and options. And this is going back a few years to my Black-Scholes model and theories of corporate finance. But a key determinant of options value is the volatility, and therefore, if volatility rises, then if you have a portfolio of options, then all things being equal, the value of that portfolio of options should go up if volatility goes up. So that, in two reasons, I think, is why BH Macro or macro funds typically are positively correlated to VIX. Now, I wish I could have a graph, but maybe I could. It's a good idea. Maybe we should publish it on our website. Yeah.
The second correlation-related question is, if bonds and equities move in line, how does this impact the fund's performance?
So if bonds and equities move in line, i.e. they are correlated,
yeah.
Well, I think this graph basically says it's hard to determine exactly what is going to happen. Now, the whole point about having no structural correlation to either bonds or equities is in that it's basically impossible to predict what will happen in any particular scenario. And I think that's the key point, is that the portfolio or the underlying capital that's managed by Brevan Howard in the master fund is very dynamic, and so at times it will be correlated to equity markets, hopefully when equity markets are going up, and at times it will be correlated to bond markets, hopefully when bond prices are going up or yields are going down. But it isn't always the case, as this graph we've got here illustrates so neatly.
Fantastic. An interesting one has just come in. Are all the BH traders trading the same themes or macro views?
Very much not, is my understanding. The way that Brevan Howard is arranged is that they have obviously a load of traders. Different traders have different amounts of capital to invest, and the amount of capital to invest is determined by how successful they've been in the past, really, but also what role they perform in the portfolio. And each trader is given a different mandate. I'm sure some have pretty similar mandates, but generally they all have different mandates, and they're all very strictly policed. So their mandate might be to look at maybe very broad, so it could be like G7 interest rate futures or something, or it could be very narrow. It could be Japanese 2-year, 0 to 2-year bonds. The idea being is that they focus on these things, and that the risk managers know exactly where their firepower is aimed, as it were. And the idea is you mix all these different traders who've got different on themselves, have got different return patterns and streams, and you mix them all together so that they all fit together and benefit from Markowitz's free lunch, which is diversification. By risk managing them, by constructing a portfolio of options that have a small downside for a high upside, depending on what eventuality happens, but also risk managing them. So stop loss is a effectively way of cutting off the left tail of the sort of normal distribution of returns. You've got a very, the whole portfolio is hopefully asymmetrical or convex, and that means that you can hopefully get some good upside. But the whole idea is that within the portfolio, and some people ask, well, what can we have a look at what's underlying the BH Macro, portfolio, like it would be an equity fund, and you could look over and go, okay, they're Netflix, and it would make sense to you, or a little bit anyway. Unfortunately, with BHA, they don't tell people what's going on underneath the portfolio. Don't give you a portfolio rundown. But even if you did read it, it wouldn't make any sense to you, because each trader has their own book, and those books make sense. But when you aggregate them all together, sometimes you can have traders who are taking opposite views, and that may make sense in the context of the portfolio and the traders. But also they put on different trades, which they structure their own trades. So they may be long equity markets, but may have some sort of hedge that somehow minimizes the risk and is part of a wider macro theme that they're trying to look at. So I was so basically I think they are all heavily risk managed. They all have very different exposures, but that's what Brevin Howard got a very big risk team that are basically trying to aim to make sure that there's no crowded trades and not everyone's doing the same thing within the master fund.
Great, thanks. We've got time for a few more questions, so if you'd like to keep submitting them, we'll try and get through them. Another question is, how would you say BH Macro differs from other hedge fund investment trusts?
So there aren't actually there used to be a big raft of listed hedge funds. Many of them became UCITS funds. The only two I think that are really, there's Boussard and Gavaudan, that's winding up or has wound up. There's Gabelli Merger Plus, and I think there is which other one? Anyway, so I mean, I guess the key is that BH Macro is unequivocally, or Brevin Howard unequivocally macro managers, and there aren't any other macro listed hedge funds basically. So that in itself is a differentiator. But obviously, Brevin Howard as a house, every year there's which is relatively widely publicized. There's a private bank that does a sort of list of the hedge funds have generated the biggest returns for investors in dollar terms since they launched, and I think Brevin Howard rank as number 15 in global terms over history. So they are absolutely a sort of the real deal, as I said at the end of the presentation. They're a proper hedge fund that just happens to have a listed feeder fund, and I think that's a great thing for the London market.
Fantastic. Two more questions before we let you go. Another question, why are BH Macro's fees higher than for other investment trusts?
Well, fundamentally, Brevin Howard is a hedge fund. It's not a quasi hedge fund or an equity fund. An equity fund fees have obviously been going down. 1% used to be the sort of old number, now 50 basis points. And I think that is obviously a good thing. Brevin Howard is unique, and they seem to have a considerable amount of AUM that investors have put with them. So they're not out of line with hedge fund fees. So and indeed some hedge funds charge more. But 2 and 20 is a sort of classic, and has been for a long time, fee structure that hedge funds have, and Brevin Howard are no different. So the reason why they've got different fees is that they are a different beast, and they offer a different role in the portfolio, and one might argue that they are delivering lots of alpha for that fee, and an alpha net of fees. It's important to add.
Great, thank you for that. And one last question, which I think is a very good question on which to end. Do you think the current macro environment is good for BH Macro?
Gosh, I think a lot of volatility is generally, or has historically been, good for BH Macro and Brevin Howard. The past is, the future is always uncertain. With Donald Trump coming in, it's difficult to know what the prognosis is for global economies. But certainly, uncertainty is a good thing for Brevin Howard. The really difficult time for them in the past was during when central banks basically said interest rates are going to be zero, and they're going to be zero forever until we review it. And that was a terrible time for them to make money. There was no, there were only two horses in the race. Everyone was betting on the favorite, and the favorite always romped home. And that is just terrible for bookmakers, terrible for macro managers, and where you're trying to sort of price in for other things to happen, and then maybe they do. So I think we're very far from that environment now. So I would say it's an opportune moment, or it does feel like a good environment for BH Macro and Brevin Howard, in my view. But obviously, who knows? And as we've said, past performance is no guide to future performance, and that is obviously clearly one of the risks that people got to get their heads around.
Fantastic. Thank you very much for answering all those questions. And that's all we have time for today. If you'd like to find out more information, please take a look at our guide to investing in hedge funds on the KTI website, as well as our latest research note on BH Macro. We'll also put a recording of this session on the KTI website too. But on that note, thank you very much for joining us today, and we hope you join us again soon.
Thanks so much, Joe, and thank you everyone for dialing in.